Let's get into it.
Japan's Nikkei plunged 12.4% today as Asian stocks tanked after new U.S. data fanned fears of a recession.
The major index is plunging today after the weaker than expected jobs report. One place we saw a spike, well, that was in the volatility index.
And when Warren Buffett sells off half of his Apple stake, capping his 800% gains, selling off about $80 billion in stock and cashing up to $277 billion.
Israeli strikes have killed a Hamas political leader and a Hezbollah commander.
U.S. credit card balances hit another new record, reaching more than $1.1 trillion.
Ultimately, it pointed towards a trend that many investors feared would lead to a recession.
The U.S. stock market is crashing, and there is a lot of speculation as to what is causing this, including some cold hard data on what is actually happening. Now, a lot of this crash is to do with some very key important information that has come out over the past couple weeks here, and in this video we're going to go ahead and we're going to dive deep into it and get to the bottom of what's going on with this stock market crash, and if this is just a correction or if we are in fact actually entering into a bear market. This is it, you guys. We just had another aggressive down day after having an initial little spike from this big sell-off that just occurred, but as you can see, it looks like things are continuing on the downtrend. If we go ahead and we take a look at this, you can see we already broke through a very strong trend line right there, and now we have this secondary trend line coming in right here that it is going to most likely come down to and test if this correction or if this drop continues to play out. Now, there's several different things to note when it comes to what's happening in the stock market right now, and one of the things to do with it is how aggressively it's actually dropped. Now, this is not just a simple little drop. This was a very aggressive drop, and the economy in the US is kind of starting to show some cracks. There's some things going on that are indicating that maybe things aren't actually as good as they seem. But of course, this drop isn't all to do with the stock market. There is other stock markets in play when it comes to why this drop occurred, and one of the things that factored into this drop was actually Japan's stock prices and how they plunged, including the entire Japanese market and how that all dropped with a massive sell-off that occurred. Here you can see the main index for the Japanese stock market, the Nikkei, ended the day a staggering 12.4%, drawing a comparison to Black Monday. This is some scary stuff going on here. The Japanese stock market crashing like this was predominantly due to something called a carry trade. A carry trade essentially means that people or investors, companies, individuals go to Japan to secure financing or secure loans at a much lower interest rate than they would find in their country or another country. Then they go and they take that money that they borrowed from Japan and they invest it into various avenues. Why this became an issue is because the Bank of Japan has kept their interest rates near zero for years, and we're not just talking a couple years, we're talking upwards of a decade. Then what happened is they ended up raising their interest rate from zero in the past week. The people that were borrowing from Japan were betting on the interest rate staying the same and not increasing or even potentially going down. This resulted in traders scrambling to sell their high-risk dollar-dominated assets to cover suddenly higher borrow costs, plus of course the losses that they incurred from exchange rates and losses in asset values as all these shares are plunging. So if you're a person that happens to do one of these carry trades, not only are you having to deal with the fact that you now have a higher interest rate on that money that's borrowed, you're also dealing with your entire portfolio that you potentially had invested dropping dramatically. Now, another contributing factor that's coming into play, and I personally thought that this was already there, but it's just kind of coming through the surface a little bit more, is the consumer sentiment and the consumer strength. For the past year, if not a year and a half, we've been hearing the same story that the consumer is strong. But what ended up coming out last week was a jobs report. And what this job report showed was that hiring in the US by employers slowed last month by much more than expected, which means that there's starting to be some signs of weakness in the labor market coming through. When it comes to the US economy, consumer spending makes up nearly 68% of the national GDP. Now, we've been hearing the same story that the consumer is strong, and that in part is to do with the fact fact that the consumers are still spending. This definitely does show on the back end that the consumer is strong because people are actually spending based on scenarios that aren't actually real. We have US credit card debt hitting a record $1.1 trillion. Now, that's a lot of credit card debt. And what do you think this credit card debt is connected to? Of course, there's going to be a large portion that's attached to necessary spending. So things like childcare, things like food, those kind of things. But a large portion of this credit card debt is also connected to consumer spending on things that people don't actually need. What this can do is this can essentially create a false positive feedback loop on GDP. And as cracks start to form and things start to come to the surface, it's going to create a lot of uncertainty and worry or even fear within the markets and within consumer sentiment. You have people spending money that they don't have on credit cards, and now we have jobs that are getting taken off the table. Unemployment is rising, and what this is creating is even more credit card debt. Now, what's interesting about this rise in unemployment is it triggered the SAM rule. And here's a chart just showing you how the SAM rule indicator actually works. You can see these little gray areas are where recession or recession structures formed prior to a big drop. And as we come through, you can see the last one that we had was back in 2019 when we had all that stuff happen. And now here we are again, back on the rise. The next thing we need to look at, just to get a feel for how the economy is actually holding up, is we look at the VIX, which is essentially a fear gauge. It's hit its highest level since the pandemic market plunge in 2020. There is something happening right now, and it is changing market sentiment to fear. And in all honesty, I think that fear is somewhat justified. As you probably already know, there's the war that's going on within Israel. But what's happened over the past week here was an assassination of a Hamas leader, and that resulted in a potential retaliation. And as more things play out within this war, and as more things happen like this assassination, there's actually things playing out in the US that indicate this may actually be something in the works. What's interesting is Lockheed Martin, their stocks are actually soaring 23%. But it's interesting to see how certain investors are deciding to allocate money to that stock based on what essentially is an assumption that there could be tough times ahead. Now, another thing to do with all the unrest in the Middle East that just recently came out is that Turkey's actually been talking about how they might enter Israel to help Palestine in their war efforts, adding just another layer or player to the story and how things are unraveling out there. So it's been an absolutely crazy couple of weeks. There is no denying that. And the way that the market's reacting is somewhat justified. We're going to continue to watch this and see how things play out over the month of August to see if this is just in fact a small correction or if we are actually entering into some form of a bearish market. And it's all going to be dependent on how this news and how this story continues to play out. As the market goes up, sentiment and news and all the information coming out tends to be relatively good. When the market starts going down, news and the entire narrative tends to go very negative, but it depends on how long it stays negative. If things continue to stay negative for an extended period of time, the likelihood of the market actually entering a bear market is much more likely because, of course, the stock market isn't just based on numbers, it's also based on emotion.